In the United States, loans play a major role in how people manage money, build wealth, and achieve big life goals, like buying a house, starting a business, or paying for education. Almost every adult in the USA uses some form of loan at least once in their lifetime, whether it is a credit card, car loan, student loan, or mortgage. The American financial system is built around the idea of borrowing and repaying, and understanding how loans work is one of the most important financial skills anyone can learn. At its core, a loan is simply borrowed money that you agree to pay back over time with extra money added called interest. The person or institution that gives the money is called the lender, and the person who receives the money is called the borrower. When someone takes a loan, they sign a legal agreement known as a loan contract or promissory note, which clearly explains how much money is borrowed, how long the borrower has to repay it, how much interest will be charged, and what happens if payments are missed. In the USA, most loans come from banks, credit unions, online lenders, or government-backed institutions. Banks like Chase, Bank of America, and Wells Fargo offer many types of loans, while credit unions usually offer lower interest rates to their members. Online lenders such as SoFi, Lending Club, and Upstart have become very popular because they offer fast approvals and simple digital processes. The U.S. government also provides loans, especially for students and small businesses, through programs like federal student loans and SBA loans. Interest is the cost of borrowing money, and it is the main way lenders make profit. Interest is usually shown as an annual percentage rate, or APR, which represents how much extra money you pay each year on top of the original loan amount. For example, if you borrow $10,000 with a 10% APR, you will pay around $1,000 in interest per year, depending on the loan structure. The lower the interest rate, the cheaper the loan is for the borrower. Loans in the USA are usually repaid in monthly installments. Each payment is divided into two parts, principal and interest. The principal is the original amount of money borrowed, while the interest is the extra cost. In the early months of most loans, a larger portion of the payment goes toward interest, and over time, more of the payment goes toward reducing the principal. This system is called amortization, and it is commonly used for mortgages, car loans, and personal loans. One of the most important factors in how loans work in the USA is credit score. A credit score is a number that represents how trustworthy you are as a borrower. It is mainly calculated using your payment history, total debt, length of credit history, types of credit, and new credit applications. In the USA, credit scores usually range from 300 to 850. A higher credit score means you are more likely to get approved for loans and receive lower interest rates, while a low credit score can result in higher interest rates or even rejection. Because the U.S. system heavily depends on credit, many people start building their credit history from a young age, using credit cards or small loans. Lenders use this history to decide whether you are a low-risk or high-risk borrower. This means two people applying for the same loan amount can receive very different interest rates based only on their credit score and financial behavior. In the USA, your credit score can affect not only loans, but also renting an apartment, insurance rates, and even job opportunities. Understanding these basic concepts is the foundation for learning how different types of loans work in the USA, how lenders make decisions, and how smart borrowers use loans as financial tools instead of falling into debt traps.
In the United States, loans are divided into several major categories based on their purpose and structure. Each type of loan is designed for a specific financial need, and understanding these categories helps people choose the right loan and avoid unnecessary debt. The most common types of loans in the USA include personal loans, credit cards, student loans, auto loans, and mortgages, and together they make up the majority of consumer debt in the country. Personal loans are one of the most flexible types of loans in the USA because they can be used for almost anything, such as medical bills, travel, wedding expenses, or consolidating other debts. These loans are usually unsecured, which means they do not require any collateral like a house or car. Because the lender is taking more risk, personal loans often have higher interest rates compared to secured loans. They are typically repaid over a period of 2 to 5 years in fixed monthly payments, making them predictable and easy to manage. Credit cards are technically a form of revolving loan, which means there is no fixed end date as long as the borrower keeps making minimum payments. In the USA, credit cards are extremely common and are used for daily expenses like groceries, fuel, shopping, and online purchases. Each card comes with a credit limit limit, which is the maximum amount the user can borrow. Interest rates on credit cards are usually very high, often between 18% to 30% APR, which makes them one of the most expensive forms of borrowing. If the full balance is not paid every month, interest starts accumulating, and this is how many people fall into long-term debt. Student loans are a major part of the American financial system, especially because higher education in the USA is very expensive. These loans are used to pay for college and university tuition, books, and living expenses. There are two main types: federal student loans provided by the U.S. government and private student loans offered by banks and private lenders. Federal student loans usually have lower interest rates, flexible repayment options, and income-based repayment plans. Private student loans, on the other hand, depend heavily on credit score and often have higher interest rates and fewer protections for borrowers. Auto loans are used to buy vehicles such as cars, motorcycles, and sometimes even boats. These are secured loans, meaning the vehicle itself is used as collateral. If the borrower stops making payments, the lender has the legal right to repossess the car. Auto loans in the USA range from 3 to 7 years, and interest rates depend on credit score, loan term, and whether the car is new or used. New cars generally qualify for lower interest rates, while used cars have slightly higher rates because they lose value faster. Mortgages are the largest and most important loans in the USA for most people. A mortgage is used to buy real estate, mainly houses and apartments. These loans are long-term and usually last 15 to 30 years. Because of the long duration and large amounts involved, mortgages have relatively low interest rates compared to other loans. Just like auto loans, mortgages are secured loans, and the property itself acts as collateral. If the borrower fails to pay, the bank can take ownership of the property through a legal process called foreclosure. Each of these loan types serves a different purpose, but they all follow the same basic principle. Borrowed money must be repaid with interest over time. The key difference lies in how risky the loan is for the lender and how expensive it becomes for the borrower. When someone applies for a loan in the United States, the lender does not simply give money based on trust or personal relationship. Every loan goes through a formal evaluation process where the lender analyzes the borrower's financial profile to measure risk. This process is called underwriting, and its main purpose is to answer one simple question: how likely is this person to repay the loan on time and in full? The first and most important factor lenders check is the credit score. As discussed earlier, a credit score reflects a person's past behavior with money, including whether they paid bills on time, how much debt they already have, and how long they have been using credit. In the USA, most lenders use the FICO score model, and even a small difference in score can significantly affect interest rates. For example, a borrower with a 750 credit score may get a loan at 6% interest, while someone with a 620 score may get the same loan at 15% or higher. The second major factor is income. Lenders want to make sure the borrower has enough stable income to handle monthly payments. This is why applicants are often asked to provide proof of income, such as pay stubs, tax returns, or bank statements. It is not just about how much money someone earns, but also how consistent and reliable that income is. A person with a steady full-time job is usually seen as less risky than someone with irregular freelance income. Another critical factor is the debt-to-income ratio, commonly known as DTI. This ratio compares how much money a person already owes each month to how much they earn. For example, if someone earns $4,000 per month and already pays $2,000 in existing loan payments, their DTI is 50%. In the USA, most lenders prefer a DTI below 40% because a high DTI indicates that the borrower may struggle to handle additional debt. Lenders also evaluate employment history and financial stability. Someone who has been working at the same company for several years is considered more reliable than someone who changes jobs frequently. Savings and assets also matter, especially for large loans like mortgages. If a borrower has emergency savings, investments, or property, the lender feels more secure because the borrower has backup resources in case of financial trouble. For secured loans, such as auto loans and mortgages, lenders also assess the value of the collateral. This means they calculate how much the car or property is worth compared to the loan amount. This is known as the loan-to-value ratio, or LTV. A lower LTV is better for the lender because it reduces their risk. For example, if someone buys a $200,000 house with a $40,000 down payment, the loan is $160,000, which means the LTV is 80%, and this is considered a healthy and safe level. Once Once all these factors are reviewed, the lender either approves or rejects the application. If approved, the borrower receives a loan offer that includes the interest rate, loan amount, repayment term, and total cost of the loan. The borrower can accept or decline the offer and sometimes negotiate better terms if their financial profile is strong.
In the United States, interest rates are one of the most important elements of any loan because they determine how much extra money a borrower will pay over time. Two people can borrow the same amount of money for the same purpose, but end up paying completely different total amounts just because of different interest rates. This is why understanding how interest works is critical before taking any loan. Interest rates in the USA are influenced by several factors, starting with the Federal Reserve. The Federal Reserve, also known as the Fed, is the central bank of the United States, and it controls the base interest rates in the economy. When the Fed raises rates, borrowing becomes more expensive across the entire system. When the Fed lowers rates, loans become cheaper and easier to access. This affects everything from mortgages and car loans to credit cards and business loans. On a personal level, the interest rate a borrower receives depends heavily on their credit score, income, loan type, and market conditions. Lenders always price loans based on risk. A borrower with strong credit, stable income, and low existing debt is considered low risk and is rewarded with lower interest rates. A borrower with weak credit or unstable income is considered high risk and is charged higher interest to compensate the lender for the increased chance of default. In the USA, loans usually come with either fixed interest rates or variable interest rates. A fixed interest rate means the rate stays the same for the entire life of the loan. This makes monthly payments predictable and stable, which is why fixed rates are very popular for mortgages, auto loans, and personal loans. Borrowers prefer fixed rates because they are protected from future increases in interest rates. Variable interest rates, also known as adjustable or floating rates, can change over time based on market conditions. These rates are usually tied to a benchmark, such as the prime rate or SOFR. At the beginning, variable rates are often lower than fixed rates, which makes them attractive. However, if market rates rise, the borrower's monthly payment can increase significantly. This is common in adjustable rate mortgages and many credit cards in the USA. The real cost of a loan is not just the interest rate, but the total amount paid over time. This includes interest, fees, and sometimes insurance or penalties. For example, a 30-year mortgage may have a low interest rate, but because of the long duration, the borrower can end up paying almost double the original loan amount. On the other hand, a short-term loan with a slightly higher rate may actually cost less overall because it is repaid faster. Another important concept in the USA is compound interest. This means interest is charged not only on the original amount, but also on previously added interest. Credit cards are the best example of this. If someone carries a balance and only pays the minimum, interest keeps compounding and the debt grows rapidly. This is why credit card debt is one of the biggest financial traps in the American system. Understanding interest rates, loan terms, and total cost allows borrowers to make smarter decisions and avoid long-term financial stress.